Greetings, I'm Shaun Pruitt, Zacks equity strategist, and today I'm going to be discussing if income investors should add positions in Comcast or AT&T stock near 52-week lows. So high yield dividend stocks often attract investors when share prices retreat, creating opportunities to lock in higher income streams. And that has become the case for telecom and communications giants Comcast, ticker symbol CMCSA, and AT&T, ticker symbol T. So both of which have recently traded near the 52-week lows of around $22 a share, respectively. So for income investors seeking reliable cash flow from established companies, the recent weakness in Comcast and AT&T stock raises an important question. Are these quality dividend payers trading at bargain prices, or are their declines signaling deeper concerns? So we'll just briefly discuss why Comcast and AT&T stock have declined. So while both companies operate in communications and connectivity, the reasons for their stock weakness are somewhat different. So Comcast has struggled with persistent broadband internet subscriber losses as consumers increasingly turn to fixed wireless alternatives offered by telecom competitors. And despite posting solid earnings results, investors have remained concerned about slowing growth in the company's core cable broadband business as well. And ongoing pressures in its media operations. So the market has questioned the long-term growth outlook for traditional cable providers like Comcast as competition from digital streaming services intensifies. So AT&T, meanwhile, has faced investors' concerns related to its substantial debt burden, competitive wireless pricing pressures, and occasional free cash flow disappointments. And although AT&T continues to add fiber and wireless subscribers, investors remain cautious about whether its growth will be sufficient enough to offset heavy capital spending requirements and ongoing debt reduction efforts. So the result is both stocks have drifted lower despite generating significant cash flow and maintaining their dividends. So Comcast, just a brief comparison between Comcast and AT&T's dividend. So following its recent sell-off, Comcast dividend yield has climbed to nearly 6%, making it one of the more compelling income opportunities in the communication space. And the company continues to generate substantial free cash flow from its broadband, business services, media, and entertainment operations, supporting both its dividend and long-term capital allocation strategy. And AT&T also remains an appealing income stock with a dividend yield around 5%. So the telecom giant benefits from recurring wireless and broadband subscription revenue, which provides a stable cash flow base to support shareholder payouts. And plus, AT&T's management has continued to emphasize free cash flow generation and debt reduction while maintaining its dividend. And there you can see AT&T and Comcast dividends. Comcast is close to about 6% right now, with AT&T at 5%. So very enticing yields. That said, Comcast currently offers both the higher yield and stronger dividend growth profile. And to that point, Comcast has increased its dividend for 18 consecutive years, with annual dividend increases dating back to 2008. And on the other hand, AT&T was once a dividend aristocrat with 36 consecutive years of dividend increases, but that streak ended when management cut the dividend by roughly 47% in 2022, following its Warner Media spinoff. So since then, AT&T has maintained its dividend at approximately $1.11 per share annually, rather than increasing it. It's also noteworthy that Comcast has the more attractive payout ratio of 33%, which you can see here, compared to AT&T's 51%. And this indicates a wider margin of safety for future dividend hikes, although both companies appear to have well-covered payouts. And there you can also see Comcast's annual dividend growth rate over the last 5 years was at a very respectable 7%. And it's currently $1.32 per share on an annual basis. And again, that almost 6% dividend yield there. So looking beyond their yields, it's important to consider debt and return on invested capital. So income investors should never evaluate dividend stocks based solely on yield. Long-term dividend sustainability often depends on balance sheet strength and the ability to generate attractive returns on invested capital, or ROIC. So Looking at Comcast's financial position, it maintains a sizable debt load, but its financial profile remains manageable given the company's strong cash generation capabilities. And Comcast continues to produce billions in annual operating cash flow and free cash flow, allowing it to support dividends, repurchase shares, and gradually manage its debt obligations. So, from an efficiency standpoint, Comcast's ROC has recently stood near 8%. As you can see here, reflecting a business that continues to generate returns above many traditional telecom peers despite competitive pressures. And Comcast currently has 272 billion rather in total assets compared to 175 billion in total liabilities, which includes 93 billion in long-term debt. And pivoting to AT&T's financial position, AT&T's balance sheet remains the larger concern. So although AT&T has significantly reduced debt since its media divestitures, leverage remains elevated compared to many dividend-paying blue chips. And management continues to prioritize debt reduction while simultaneously investing heavily in fiber expansion and 5G infrastructure. So the positive news, however, is that AT&T's recurring revenue model generates predictable cash flow, helping support both its dividend and deleveraging plans. So, however, investors should recognize that the company's capital-intensive business model leaves less flexibility than Comcast in the event of an economic slowdown or increased competition, with AT&T's ROIC at around 6% at the moment. Which you can see here. So AT&T currently has 420 billion in total assets, but has roughly 294 billion in total liabilities, which includes 127 billion in long-term debt. So still a solvent company, but it does carry quite a heavy debt load. So Comcast and AT&T's cheap valuations are certainly what might be most compelling to investors, with both stocks trading under 10 times forward earnings, as you can see here. And they're also beneath the often preferred level of less than 2 times forward sales. And Comcast is currently at about 6 times forward earnings, with AT&T at 9 times forward earnings. So that might be most intriguing to investors, which magnifies their cheap stock prices as well. So just conclusion and strategic thoughts here. Comcast and AT&T offer attractive income opportunities for investors willing to tolerate moderate business and industry risk. For long-term income investors looking to add positions in established cash-generating companies that are trading near 52-week lows, both stocks warrant consideration. Still, investors should balance the attractive yields against the competitive and operational challenges facing each company. And for now, Comcast and AT&T stock both land a Zacks ranked number 3 hold, suggesting investors who already hold positions may want to maintain them while monitoring future improvements in business fundamentals and earnings trends. In regard to adding positions, there could still be better buying opportunities ahead, although it's getting hard to overlook these top blue chip dividend stocks at their current levels. Again, I'm Shaun Pruitt, Zacks Equity Strategist. I hope you enjoyed this content. For more, please feel free to visit zacks.com/promo.